Most people obsess over the interest rate. I care more about how big a mortgage you're actually signing up for in 2026. A lot of brains are still anchored to two moments: the pandemic, where a 5-year rate started with a 1 or a 2, or the period where 5 to 6% 5-year rates were showing up in people's actual approvals and renewals. We are in neither of those places now. As I'm recording this in early 2026, most first-time buyers I see qualifying for insured 5-year rates at around plus minus 4%, depending on the file and the lender. Most forecasts expect 2026 to stay roughly in this range, so I treat this level as the range we plan around. What matters is not just the rate. What matters is the rate plus the purchase price and what that turns into every month. Let me show you an example using real years. Scenario A, peak frenzy early 2022. This is the type of purchase I was seeing a lot in the height of the market. Purchase price, $1 million. Down payment, 20%, $200,000. Mortgage, $800,000. Interest rate, 2%, 5-year fixed. Amortization, 25 years. The rough principal and interest payment on that mortgage is about $3,400 a month. That's before tax and insurance. Scenario B, 2026 reset. In many pockets, prices from that 2022 peak have come down in 15 to 25% range. So let's use a simple 20% drop for comparison. Purchase price, $800,000. Down payment, 20%, $160,000. Mortgage, $640,000. Interest rate, 4%, 5 years fixed. Amortization, 25 years. The rough principal and interest payment on that mortgage is also about $3,400 a month. So in both cases, you're paying roughly the same amount every month. But in the 2026 scenario, the purchase price is $200,000 lower. Your starting mortgage is $160,000 smaller, $800,000 versus $640,000. You've kept $40,000 in your pocket instead of putting it into down payment on a more expensive home. Your land transfer tax and closing costs are lower because they're based on a smaller purchase price. You can absolutely choose to put more down if you have it and push the payment even lower. The point is that a higher rate on a smaller loan can land you in the same monthly ballpark as a low rate on an inflated purchase price. But over the long term, those two decisions are not the same. Borrowing $640,000 is a completely different commitment than borrowing $800,000. Most buyers still obsess over the interest rate. Is 4% good or bad? I care much more about one thing. How much am I actually borrowing, and does that amount make sense for my income and my life?